Welcome to Nasdaq Trade Talks. I'm Jill Malantrino, Global Markets Reporter at Nasdaq. Joining me to discuss how investments and sustainability have evolved over time and the path for growth with ESG is Eva Palmberg. She's the head of sustainable investments at Nordea. Eva, it's great to have you with us. Welcome to Trade Talks.
Thank you very much.
How have sustainable investments developed over time?
So there have been quite a massive increase over the last half decade. And you can see in the graph that we have showed the asset under management in Europe development from 2007. And one of the key drivers of this has been that more and more institutional investors has committed to the PRI, which is the principle of responsible investments. And when you sign that, you really commit of integrating ESG into your investment process. We can also see that more and more retail investors are allocating their assets to sustainable investments as well. And that has been quite a sharp increase in the last couple of years. And then you can see also on the graph is the regulatory development. And that has also increased massively. And also actually from 97% of all the regulations that come into place in sustainable finance has happened after the year of 2000. And we are expecting a lot more of these in the next couple of years, especially in Europe, because we have, the Green Deal and the sustainable finance activities. And this trend is important because now, sustainable finance is moving from, niche regulations to more mainstream regulations like the MiFID II, for example.
What are some of the different sustainability investing approaches?
So that is one of the challenges for many investors, that there are so many different approaches within the same definition, sustainable investments. So it spans over from exclusions to impact investments. And one of the most common one, and also the oldest one, is exclusions. And here you exclude companies mostly based on ethical reasons. And this started already back in 17th century, where there was a lot of religious investors that started to avoid investing in companies which violated their religious belief. But we can see a shift here happening in 2015 especially, where as investors become more and more sophisticated, and they see that many of the challenges that can both hit a company specifically, as well as the more broader economic risks, are related to ESG factors, that is environmental, social, and governance factor. And we see this ESG integration, increasing in assets.
Let's go into more detail about the three key verticals of ESG and provide us with some examples.
So as I mentioned, the ESG stands for environmental, social, and governance. And that is that, investors are applying this into their analysis and investment process. And in a way, then, identifying material risk and growth opportunities. And when you're looking at in the environmental factors, here you look at what environmental risks the company is exposed to and how well they're managing those risks. So you look at everything from the production to the actual product. And the different metrics is that you can look at, for example, is how is that company handling their waste? How energy efficient is that company? And how much water is used in the production, to give an example. Then you have, of course, the social factors. And here is more about how is the company business model impacting the society that it operates in, and how central, for example, diversity and social justice is into the core business model of that company. And this spans over a wide range of factors, everything from fundamental issues like human rights to product quality and safety. And then lastly, you have governance factors. And here you identify how the company is operating in a way that is aligned with business ethics, and how this is really building the trust both from investor point of views as well as the employees and customers. And here is also quite broad span of metrics as you look at, everything from how transparent the company is reporting to how is the processes so they avoid risk relating to briberies, to give an example.
Eva, what are some of the risks associated with ESG and how does that impact returns?
So we did a study in our sustainable investment publication, which is a publication which we just launched. And here we looked at many different academic research, and we was trying to find, okay, so what different approach you have at ESG, what has that impact of returns? And what we found that there's not really a strong evidence relating to exclusions. But exactly what we talked about here, the ESG information, the ESG risk, if you're incorporating that into your investment analysis, that has potential to add returns to your investors. And we're trying to explain this in 3 different channels, which we call the selection, the trend, and impact effect. And all these 3 effects affects the demand for sustainable assets relative to non-sustainable assets, and therefore, the asset price as well as the performance. And in short, the selection effect is, when you take this information that we just talked about, that changes, what company you invest in, or affects what companies you invest in. And if those risk and opportunity realize, that has an impact of return. Then we try to explain like the trend effect, and that is more like the flow of the assets and what impacts that into those more sustainable companies. And finally, when we talk about impact effect, is the increase in demand of investing in the solutions. And we can say that we talk a lot about ESG and sustainability, but if we're thinking about it, this trend from a historic perspective have just started.
How did COVID-19 impact ESG investing and what's your outlook on the other side of COVID-19?
Yeah, so COVID-19 is obviously something that we are experiencing right now as we speak, and it has affected us all personally. And we still see what sort of the long-term effect will be, both from a social and economic perspective. From an ESG point of view, we can see that sustainable funds has performed better during the crisis, as well as the outflow has been less in those funds which has a sustainable profile. And of course, we're looking at the performance. Many of these funds has less exposure, for example, to the oil sector. But what we can also see that companies that are well positioned within ESG, they're often better, well-run companies. They are less controversial companies and often treating the stakeholders and employees a little bit more fairly, which has been favored than in this market. And I think the social aspect will be much more in focus, and we will see that how management and companies have prioritized their employees' welfare and financial security during this crisis will be very clear. And then, of course, also how they treated the customers and how innovative you have been of adapting your business model to the new circumstances. So there will be a lot of things that will come up to surface, I think, relating to this. But then we will also look at the recovery packages, which are some record amounts, and see how they support the green recovery. And focusing a little bit on the green recovery is climate change. When we look at ahead of the future, climate change is obviously one of the biggest challenges that we are facing today. And the economic growth that we have experienced has gone very much hand in hand with carbon emissions, since the production that we have increased has been we use energy from fossil reserves. And if we're looking at, you know, in order to meet the goals of the Paris Agreement, you know, the whole society sort of needs to change. And we have, if you look at the policies that are in place at the moment, we will not meet the goals of the Paris Agreement. So this puts, you know, expectations that regulations and investments can increase from governments. We can also see that there's more and more investors saying that we need companies to disclose this. We need to see what the financial materiality impact will be. And if this become more transparent, you know, more and more investors can take this risk into account. So looking at these different aspects, you know, regulation, investors' demand, we also see business leaders seeing bigger risk relating to this. You can see the selection trend and impact, in fact, has potential to increase even more in importance in the future.
Okay, Even, to wrap up here, what are some quick examples of a sustainability footprint that investors can identify with?
So we launched this in collaboration with Nasdaq in order to really make it easy for our clients to see, you know, how are their investments exposed to some of these factors. So, for example, you can see how, you know, the underlying companies have a water usage, how is the waste generation, the carbon emission, as well as future carbon emissions when it comes to the fossil reserves in oil, gas, and coal.
All right, Eva, great to have you with us. Thanks so much for joining us on Trade Talks.
Thank you so much.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.